For the past few years, everyone's been talking about inflation and interest rates. But what if I told you the real story, the one that kind of explains everything, was about something you've probably never even heard of? It's like this giant financial sponge the Federal Reserve uses, and honestly, its journey tells us so much about our economy's recent wild ride.
So check this out. This is the mystery we're diving into. In 2022, this tool, this thing the Fed has, just suddenly swelled up to hold over $2.6 trillion out of nowhere. So why? What on earth was going on? And what did it mean for all of us? Okay, let's just sit with that number for a second. $2.6 trillion. I mean, that is a staggering, almost unimaginable amount of cash just being parked somewhere every single night. It's huge.
To make sense of all this, we're going to use a really simple idea. A sponge. And look, this isn't just some gimmick, I promise. If you watch how this sponge soaked up all that cash, and then how it got wrung out later, you get this incredibly clear picture of the massive forces that are really shaping our financial world.
All right, so our story really begins with a flood. Because, to understand the sponge, you first have to understand where all the water, or in this case, all this cash, even came from in the first place.
Yeah, it all really kicked off back in 2020. I mean, with the pandemic, the U.S. government just unleashed this unprecedented wave of spending to keep the economy afloat. We're talking stimulus checks hitting your bank account, loans for businesses, extra unemployment benefits, just a massive, massive fiscal response.
And, this wasn't really a partisan thing. As you can see here, policies from both the Trump and Biden administrations led to this historic increase in money in the system. The key thing here isn't about who spent it, but just the incredible volume of new cash that was being pumped into the economy.
And this created a very specific problem, a term you hear a lot, excess liquidity. The best way to think about it is like the financial system's plumbing was just completely overwhelmed. There was way, way more cash just sloshing around than the economy could actually use for normal stuff. And of course, when you have all that extra money chasing the same amount of goods, well, that's a classic recipe for inflation. And that is when the Fed had to pull out its sponge.
Okay, so let's pause the story for a minute and actually look under the hood. What is this financial sponge? Well, its technical name is the Reverse Repo Facility, or you'll just hear it called the RRP.
Now, what's really cool about this is how simple the contrast is. In a normal repo, the Fed is giving cash to banks to boost liquidity. But in a reverse repo, it's doing the exact opposite. The Fed is basically saying to big financial players, hey, give us all your extra cash overnight. In return, we'll give you a super safe treasury bond as collateral, and we'll even pay you a little interest. It's really just a temporary deal to soak up that extra cash from the system.
So during this time of just crazy excess liquidity, this tool did three really critical things. One, it managed all that extra cash, right? It kept it from overheating the economy and driving inflation even higher. Two, it put a floor under interest rates, which is absolutely crucial for keeping markets stable. And three, it gave these big financial firms a totally risk-free place to park all that money they suddenly had. So who was actually using this thing? Well, as you can see, the main players by a long shot were money market funds. Now, these are the funds that manage cash for millions of us, inside our retirement accounts or brokerage accounts. Their assets just swelled to over $5 trillion, and they were desperate for a safe place to put all that cash. The reverse repo facility, it became their #1 essential go-to spot.
Okay, so the sponge is now completely full, soaked. Let's get back to the story. Because what goes up must come down. A sponge just can't stay full forever. And starting in 2023, the Fed began the process of wringing the whole system out.
And wow, the drop was just as dramatic as the climb up. Just look at these numbers. From that peak of $2.6 trillion, usage just plummeted, all the way down to around $32 billion by the middle of 2024. This was a really clear, intentional signal from the Fed that whole era of extreme excess liquidity was officially coming to an end.
So what made this happen? Well, two big things. First, the Fed started something called quantitative tightening, or QT. It's basically the opposite of money printing. Instead of buying bonds to put cash in, the Fed just lets its old bonds expire. When the government pays the Fed back for those bonds, that cash just disappears from the financial system. At the same time, the U.S. Treasury started issuing new short-term bonds that actually offered a better interest rate, giving those money market funds a more attractive place to put their money. Okay, so this is the big question, right? Why should any of this financial plumbing matter to you?
Well, because the amount of water in the sponge, the amount of liquidity, has a direct, real-world impact on your investments, your savings, and frankly, the value of the dollars in your pocket.
And this quote here really just nails it. The ROP is a direct lever on how much cash is actually available for investment in the economy. And that availability of cash, it has this huge, huge influence on the price of pretty much every asset you can think of.
So let's break that down. Here's what it looks like for you, the investor. When the sponge is full, meaning the Fed is soaking up a ton of cash, liquidity gets tight. And this usually creates headwinds for your assets. Borrowing costs go up, which puts pressure on stocks. Short-term rates rise, which can hurt bonds. And there's just less speculative cash to flow into things like Bitcoin.
But, on the other hand, when that sponge is empty and all that cash is flowing back into the system, liquidity becomes easy. And that tends to be a much more supportive environment for asset prices. There's more money available to invest in stocks, bond markets work a lot better, and you can see a comeback for speculative interest in things like crypto, and even gold, as the dollar might weaken a bit.
So, after watching this giant liquidity sponge fill all the way up and then drain all the way out, what's the big takeaway here? What's the moral of the story?
Well, I think there are three really big lessons. First, the reverse repo facility is like a real-time barometer for cash in the economy. If you see that balance shooting up, you know the system is swimming in cash and the Fed is in tightening mode. Second, it just proves how deeply connected government spending and Fed policy really are. One creates the flood, the other has to manage it. And finally, it shows us the Fed's toolbox is dynamic. They've got this sponge to soak up cash, but they've also got a spigot to add it back in whenever it's needed.
You know, the journey of this great liquidity sponge gave us this fascinating, almost behind-the-scenes look at how our economy was stabilized through a really crazy time. It was an incredibly powerful indicator for a specific period. And that kind of leaves us with one final question to chew on. What's the next hidden indicator we should all be watching to figure out what comes next?